And welcome back, everybody, to the Lebenthal Report. I'm Jordan Kimmel, and it's an absolute pleasure right now to bring on a colleague and a friend, Sam Stovall. So let me jump right into it, Sam. You know, there's an expression, may we live in interesting times. This is probably one of the most interesting times. And, for guys like me who've been around for a long time, it just feels a little bit different. The volatility, the day trading that was gone for 20 years seems back. But what I want to do is we're jumping off to a brand new year, and what all our clients want to know is, what can we expect? I think we get the direction of the market right, and then I want to jump into your sector analysis, which is really important. Jump off on what we should look for the year ahead, maybe to start.
Well, first off, to acknowledge what you said, last year was an unprecedented year. We went through a 34% bear market that took only 33 calendar days to go from peak to trough, which was the fastest on record. We then recouped all that we lost in fewer than 5 months, which was the third fastest on record. And along the way, we ended up with 33 new all-time highs for the S&P 500 versus 23 on average going back to World War II. Yet we had twice the number of 1% daily moves as we did in the past. So a very scary time for investors overall. What I see going forward for 2021, I think it is going to end up being a pretty good year. We have a year-end target of 4080 on the S&P 500, which starting the year ended up being close to a 10% appreciation. I do think that volatility is likely to be with us because of all of the headwinds that we have to deal with, one of which certainly appears to be overvaluation currently. But I think that when all is said and done, investors will be happy that they stuck with stocks.
Right, and it's a matter of having a plan to start. And there's a wide belief that if you get the direction of the market right, the second most important thing is to get the sectors right. And I've read your book. I want you to just mention the book for a minute. And I'm always thinking about how to use the sector strength and weakness. And there's been an expression used twice already on the show called barbell. You've got a really, really interesting take, not only the winners or the losers, but I want you to get into, first mention your book and then get into really what the essence of what you think a barbell approach could be this year.
Sure. Well, the best bit of investment advice I ever got came from Clint Eastwood. When he was playing Dirty Harry in the movie Magnum Force, he kept mumbling through grit teeth, "A man's got to know his limitations." And I realized that I am like many investors where emotions can rule if I allowed it to. So I try to extract my emotions from the equation and embrace a rules-based investment approach. So I wrote a book called The 7 Rules of Wall Street, which are rules-based sector rotation strategies. One of which is called the seasonal rotation strategy. That is now an ETF put out by Pacer with the ticker SZNE. But last week, I wrote about the barbell portfolio, as you mentioned. We all know the old adage to let your winners ride. But then frequently people will say, but wait a minute, shouldn't I buy low and sell high? So the question is, should I be buying last year's winners or last year's losers? Historically, you probably really just want to stick with the winners. Over the last 20 years, by owning the 10 strongest S&P 500 sub-industries, there are 125 of them. So if you pick the top 10 at the beginning of each calendar year and held them for a year, instead of getting 8.4%, which is a compound rate of growth for the market, you ended up with almost 13%. And you saw an improvement in the frequency with which this portfolio went up in price. The bottom 10 sub-industries also beat the market, but you had a drop down in terms of the frequency of advance, and there was a lot more volatility. But really interesting is if you took both sides of the equation, so therefore the barbell, the 10 best, the 10 worst, so you therefore had 20 sub-industries, you ended up with a return that was similar to the top 10. You had a similar frequency of advance at 77% of all calendar years, but you had a dramatic reduction in overall volatility. So your return for risk ratio was much more appetizing by embracing both sides of the equation than simply being either with the 10 best or the 10 worst.
Right. And so you touched on something so important. It's not only the return, but at Lebenthal, our whole focus is on muting and dampening volatility. We're not looking for excitement. We're looking for solid returns with less volatility. And so that barbell approach that you have, I mean, it sounds like it could be the ticket. And so Dom and Mike, if you have something you want to jump in.
All right. So Sam, I had the pleasure of hearing you speak at a Barron's Forum probably 15 years ago at the Yale Club, and it was the first time I heard the expression "the dividend aristocrats." And you were pretty passionate about it then, and I'm just wondering now, with these large companies, as we talked about energy and some sectors that are really suffering. Is that a concept, Sam, that still works right now at this period of time? Or is it really going to be difficult for those aristocrats to continue, that unbroken chain of raising dividends every year?
Well, I think that there's certainly an appeal because, the older one gets, the more they rely on income. And so I think that income-oriented investors need to think like landlords. They want to focus on those companies that, like tenants, will pay their rent every month, but at the same time have no problem with their rent being raised every year. So the dividend aristocrat, these are companies that have a minimum annual track record of, in the last 25 years, raising the dividends. You've got about 60 companies that have done that. You can find out the names of those companies by going to proshares.com, because they're the ones that have the dividend aristocrats on the large cap and the mid cap level. And I don't get paid for saying that. You could also go to spdji.com, which is the S&P Dow Jones Indices. But when you're looking at interest rates that are about 1%, but you can find a company that is growing, that is expanding their dividends, and they're yielding 3.5%, 4% or more, and they obviously have a superior track record of paying and increasing those dividends, then I still think that they warrant attention.
Are there any stocks in the last 10 months as a result of the pandemic that broke their aristocratic streak?
Yes, there are a couple of stocks that have done that. I am not the expert on that, but again, if you go to the S&P Dow Jones Indices website, they will give you a list of those companies. I mean, I think there were only 2 out of the 60, and that's the benefit of investing in a basket of these kind of stocks, is because you get 1 or 2 that fall off the list, you get 1 or 2 that are added to the list, and it creates just a ripple rather than a wave to your portfolio.
Thanks, Sam. If I don't leave time for Dominic, he's going to have my head. So thank you for answering my question.
As Jordan mentioned, we work together, and I always find you just common sense, logical about investing. And maybe I'm going to put you on the spot. I apologize. But we saw in the industry an incredible number of people that left the market in March because they just couldn't deal with the pain. And they've been pretty much waiting all now year and into this new year. Oh, when are we going to see a significant pullback so I can finally get back into the market? The ultimate sin, sell low only to buy high. But what kind of advice would you give to people out there about, hey, I have this capital sitting on the sidelines. How do I get it back in?
Well, I think first off, you acknowledge their concerns, because when you do have a 34% decline in about a month, that can be unnerving. But at the same time, it's usually when things look the bleakest that you should be, that it represents the greatest opportunity. And also, when you see us recouping all that we lost by August, that was another sign that we probably should be getting back in. Now I would actually say that there are reasons we want to be a little bit nervous. When you look at the Russell 2000, it is trading 37% above its 200-day moving average. S&P 500 is trading at nearly 50% above its average PE ratio on forward 12-month earnings. So there could be reasons why the market might digest some of these gains. So dollar cost averaging for your average investor is probably a technique that they want to embrace. Whether you break the amount that you want to invest into 12 pieces and put 1/12 in each of the coming 12 months, that's one way of doing it. You can do it into quarters, but basically putting money to work where you're forcing yourself to add, even though you might be worried that the market is ready for some sort of capitulation.
In harvesting profits, you want to talk? I mean, some of these people that have been in have done quite well. Maybe harvesting some of those profits and putting them on the sidelines.
Well, goals are always something you want to be focusing on, whether they're long-term lifetime goals. If you are an investor and you're investing for income, then you say, well, what is my goal to buy into it? Is it because the Dividend Aristocrat now yields 4% or more? If it's a company that you bought at a very low price, but now the target is well beyond what your expectations are. Maybe that's from a fundamental basis. Maybe it's from a technical basis to indicate where the target could be. Bulls get rich, bears get rich, but pigs get slaughtered. So make sure that you do have an exit strategy as well as an entrance strategy.
Jordan?
Right. So let me just say, Sam, that you know that imitation is one of the greatest signs of flattery. And you know, Mike mentioned and Don mentioned the Dividend Aristocrats. It's really something that you trumped and you talked about probably earlier than most others. So the imitation side is that I'm running an SMA at Lebenthal based upon Dividend Aristocrats, but I bring my magnet model in, but it's all about not the highest dividends, but the dividend increase, strong balance sheets. It's one of our star performers. And you know what? When you have the smartest people on the street and you get to know them, it's okay to copy a little bit. So thanks for, you know, joining us today. But more importantly, thanks for sharing that great information 20 years ago. And I think everyone ought to read your book. And I'm still angling to figure out how I can combine stock selection with your sector selection. So we'll talk about that further. But thanks so much for coming on today, and happy, healthy New Year for you and your whole family.
Thanks to you and for everybody. I enjoyed being on the show.
Sam,
All right.
thank you very much.
Thank you, Sam. Happy New Year.